Greetings and welcome to Market Matters. I'm Khoo and this is Sulhi Azman, otherwise known as Max. Now let's talk about some companies in the news, and it's Hap Seng Consolidated Bhd. It's a diversified conglomerate from East Malaysia. They closed the day up 0.3% or 2 cents higher at $6.63. This share price has nearly doubled in the last 1 year and still only currently traded at a PE of just about 13.8 times.
Well, despite being the big fresh fruit bunch company, with 7 core business in plantations, property development, credit financing, automotive, fertilizers, etc., etc., etc. Anyway, what happened was they actually had a signing ceremony with another Handal group companies. But anyway, those are not listed. But if you look at the Hap Seng Consolidated Bhd, they also said during the press conference that they're targeting to launch the project worth about 1 billion ringgit in GDV in 2016, despite the weaker overall property market.
They've got huge balls to do that, right? Because when you look at it, automotive is 26% of the business, but property is 20% of the business, and fertilizer trading 20%, trading 17%. So, for property to contribute 20% of overall business, and for them to launch properties worth $1 billion of GDV in 2016, I got to hand it to them. They really, I hope they know what they're doing. But anyway, in terms of where their property markets are, they've got basically a couple of contributors for property development revenue in 2015. The Horizon and Nadi Bangsa and Peninsula Malaysia, Palm Heights and Astana Heights in East Malaysia, but the two stable income generators for them were basically, of course, Menara Citibank and Menara Hap Seng, which gives them good rental yields and returns. The other thing to note about this company as well is their automotive division. Correct. Mercedes-Benz cars had a huge 2015 a la Donald Trump.
Yeah, correct. I mean, the sales in FY15 surged about 56% or something like that, and of course, this would bode well for both cycle and carriage as well as Hap Seng Consolidated sales. Also reflected in the earnings. So, I mean, the earnings are actually partly affected by property development because you see the net profit were down by 19.2% despite an increased revenue of 40.4%. That was partly due to the property development revenue or business that drags the performance, but the automotive continue to be the main earnings driver.
Exactly. I mean, recession, what recession, right?
Who's now buying Malaysia, all these cars?
Well, rich people, because Malaysia is now Mercedes-Benz's biggest market in Southeast Asia. Okay, right. So to summarize, Hap Seng Consolidated Bhd are launching 1 billion ringgit worth of properties in terms of GDV for 2016. Number two, their automotive division, led by Mercedes-Benz models, are having an stellar year, and sales momentum carrying on through to 2016. And of course, their plantation division continues to be uncertain in the near term. Let's move along, guys, to CapitaLand Malaysia Malls Trust, which is our broker's call. Now, of course, this company closed down by 2.1% or 3 cents or $1.40. It's been rising by not a lot, by about 12% since end of August last year. Dividend yields not bad, about 6.2% in FY 2014, 5.9 or call it 6% in 2015. So very nice and stable business. They've got quite a lot of properties like Gurney Plaza, Sungai Wang Plaza, Tropicana City Mall. I go there quite a lot. Not a bad place. The Mines, East Coast Mall.
Yeah, and this stock, and today's broker's call was courtesy of CMMT Research, MIDF Research as well as Kenanga Research. Now, CMMT, they maintain the hold with a target price of RM1.54 today, and in the report issued, they say it was no surprise to the earnings because they actually said that the EPS was increased, forecast was increased by marginally by 0.9% to 1%, and they maintain the believe that CMMT's decent dividend yields of 6-7% will continue to provide downside protection for the share price.
Okay, MIDF reckons it's still a buy for them. They've increased their target price to 166 from 1.62, just a 2 cent increase. Now, their buy call on the company is premised on, of course, the positive rental reversion outlook for most of the property assets, which should offset the temporary weakness in Sungai Wang Plaza. Of course, if you've ever been to Sungai Wang Plaza, it's a little bit dank and dangerous right now, of course.
MRT
and all that kind of thing. Outlook for Sungai Wang Plaza should also improve upon completion of the MRT project in 2 years' time. And they've got an attractive dividend yield of 5.9%. So, of course, that's something like 2 percentage points better than FD. So if you want to put it somewhere safe, maybe a REIT might do it.
Yeah, correct. And interesting is, if you look at the Kenanga Research, right, they are actually on the different view or different path compared to CIMB, which has a call, and MIDF, which has a buy. Kenanga says an underperformed stock with a target price of RM1.31 because they see a limited upside with no fresh re-rating catalyst for the stock, while recent acquisitions are not DPU accretive in the near term. Now, they are thinking that although CMMT commands quite a decent yields, they reckon that the investors are going to remain spooked by the earnings risk arising from the Sungai Wang Plaza, which is actually being affected by the current MRT.
Okay, to summarize then, given Capital Malls Malaysia Trusts having just announced their earnings outlook, CIB, it's a hold for them in terms of no having any surprises on the stock. Target price 154. MIDFs also says maintained by, have increased their target price to 166. And Kenanga said, yeah, okay, maintain underperform. Quite a contrarian there with a target price of 131, some 20 cents lower than the closing share price. So, well, that's it from us. Thank you for watching. If you want to get more from The Edge, go to theedgemarkets.com or pick up the copy of The Edge Weekly or The Edge Daily from all sensible newsstands. Max, thank you for watching. Good night and good luck.
Good luck.